Namaste, ladies and gentlemen. Welcome to the Bharat Web3 Association's podcast, bringing you key insights from Web3 and the virtual assets world from not just India, but across the world. My name is Musheer Ahmed. I'm the founder and MD of FinStep Asia. We are powering this podcast and delighted to bring some excellent global thought leaders with us today on the topic of stablecoins. Without further ado, I would love to have my fellow podcasters and thought leaders to introduce themselves, starting off with Arushi.
Hi, everyone, and thank you, Musheer. I'm currently with Chainalysis, where I lead the policy function for Middle East, Africa, Central, and South Asia. Thank you.
Thank you. Sean?
Musheer, thank you very much for inviting me to be on this excellent panel. My name is Sean. I am a co-founder of a stablecoin fintech company called IDA, based out of Hong Kong. I'm also a policy advisor for the Crypto Council for Innovation, focusing on global regulatory engagements.
Ronit?
Musheer, thanks for having me. I run a think tank for Citi called Future of Finance, based out of Dubai, normally on a plane. And I am an advisor to a variety of tech startups and a university back in the UK.
Great. So we have a great mix of practitioners, thought leaders, and those who have seen this very closely for the last 10 to 15 years in terms of the evolution of financial services through tokenization. While before we were recording this, there was just a piece from Nandan Nilken, who is the architect of digital public infrastructure in India, talking about unlocking value for 2035. One of the points he brought up was tokenization of land and how that could unlock value of 50% of asset ownership in India, which is land. But broadly speaking, when we think about stable coins, etc., are these new? Is this a new concept to have tokenization and essentially stable coins, which are representing value with a reference to another asset? How old is this? And any of you would want to chip in and talk about why you feel this is new, or why this is like old wine that was trapped in a Siberian ice?
Maybe I'll kickstart, Musheer, and I'll certainly welcome any comments from other panelists as well. Stablecoin is not new, right? In the grand scheme of things, from a blockchain and crypto perspective, stablecoin has been around for quite some time. There have been several types of stablecoins. The majority are mostly fiat-backed stablecoins, so that means it is collateralized dollar to dollar, with the reserve being kept typically in a licensed institution somewhere. So essentially, it's a digital representation of a physical dollar, whatever currency it's actually in. Now, there normally are also other types of stable coins, primarily algorithmic stable coins or crypto asset-backed stable coins. These tend to be a lot smaller in terms of volume and usage. They're primarily being used in Web3 centric use cases, especially around decentralized finance and other type of applications. But in terms of the stablecoin markets, I mean, it's not new, but the last few years, especially after COVID, the volume of stablecoin usage have dramatically increased. To date, as of March of 2025, there's roughly about $230 billion worth of US dollar-based stablecoin out there mostly. And I think the interesting aspect, I'd love to hear from other panelists as well, is the notion of a number of stablecoin regulatory frameworks that are enacting around the world, and whether the presence of these regimes will then spur the growth of non-US dollar stablecoins, given this tremendous momentum that we're seeing around the world.
Yeah, I think it's going to be quite interesting to look at the use cases and regulatory frameworks that are driving it. But yeah, from an origination perspective, Ronit, you had a book on money, past, present, maybe the future as well, last year. Yeah, good time to plug it in, right? The future money, but it talks a lot about the past as well. And we've had Ronit on our podcast previously. How are you, from that origination perspective, new concept, old concept?
I mean, to echo what Sean just said, it's definitely a new concept in terms of it's a new technology, as in it's blockchain based. And the vast majority of it is blockchain based and linked to a fiat asset. So it's definitely new in that sense. But if you go back in history and think about what money was, this stable. So there's a broader question about what is cryptocurrency, right? Is crypto money as a means of payment? Is it an asset in itself? Is it a store of value? Is it a digital? There are all of these concepts, right? And stablecoins are the nearest bit of crypto, which is money-like. So if you go back to the origin of money, money at the start was when we started having physical embodiments of this concept of trust. Because money is ultimately, I do something for you, you do something for me, or it's a reciprocal trust-based instrument. You embody it in wheat or rice grains or coins that are made out of metal. And when you get paper money, originally in China, because the Chinese invented printing and paper. When you do printing and paper, you tend to end up inventing paper money as well. I think it was around 800 AD. Someone can fact check me, but the paper money was linked to an underlying bronze coin because most money in Imperial China was bronze coins. So that idea of paper money as an invoice, as a note linked to an underlying asset, is not that dissimilar to stablecoins, because stablecoins is like the note bit. It's like the paper money bit, but it's linked to an underlying asset, most of which is US dollar securities. And then some are algorithmic. So conceptually, it's not new because it's like money, and money's been around for millennia. But in technical form and function, it's definitely newish. And is the underpinning of the whole crypto ecosystem. Without stablecoins, I mean, crypto would barely exist.
Yeah, and I think just to kind of add to what both Ronit and Sean had said, I always kind of think about stable coins as this backbone of the crypto economy as it exists today. Like they're very beautifully, combined the power of blockchain technology, which is your whole transparency, programmability, and the efficiency associated with it, with the financial stability of the well-known traditional fiat currencies. So that's how it's not new, yet the efficiencies and the adoption we've seen with it is definitely something worth talking about. I guess one of the reasons we are here today.
Yeah, and you
You know,
could add
Musheer,
to,
maybe
go
I
ahead.
add one more point. It's just one very short point.
Yes.
I mentioned earlier I'm based out of Hong Kong and Ronit is based out of Dubai. The interesting thing is both of our local currencies are pegged to the US dollar. So in a sense, both currency are already stablecoin. In fact, the Hong Kong dollar has been a quote unquote stablecoin for 40 years. It got started in 1983. So the notion of a wrapper around a collateralized asset, as Rohin mentioned, is nothing new. It's just the fact that it's being put on blockchain and the fact that the growth has been so dramatically increased the last few years. I think that's really probably what surprises a lot of people, but also, adding a lot of interesting use cases to them.
I think we can also, the paper representation that Ronit spoke about is more on, okay, here's a physical asset representing another physical asset. And then probably from a monetary policy perspective, the whole element, Sean, you mentioned different stable coins earlier as well. The gold standard, I think, was a major way of rewiring the monetary system in some senses, in terms of which we going back to the Bretton Woods Agreement and having the US dollar being issued based on a limited amount of gold that a treasury holds, and something that other economies replicated. It's been over 52 years since that ended, and then you had the debasing element that happened. But largely that probably started providing people a way of saying, okay, let's do a reference and build on it. And the monetary pegging of different currencies, be it HKD, dirham, and others, or the Singapore case, which is a basket of currencies, is being derived from there. So we're moving from that fiat reference to now looking at a variety of different ways with a newer technology, right? I want to bring this conversation more to light, like what were the triggers for needing stable coins, right? For me, a lot of it is to do with on-off ramps and how that happened. But do you all agree with this is where it all started for us in terms of the need for stable coins, or was it something else you feel that triggered building of stable coins in 10 years ago, if we talk about blockchain native stable coins? Arushi, thoughts?
Yeah, I think so. There's this data point that I like personally a lot, right? If we look at the entire crypto market cap, stable coins are, I think, about 10% of the entire crypto market cap, right? But once we start looking at on-chain transaction volumes, stable coins are about 2/3 of it, which kind of goes back to our earlier conversation about how important they are, how widespread they are, and therefore we can then start kind of looking at mapping out their various use cases. You're right that on ramping and off ramping is extremely important when it comes to stable coins, but I'd actually like to take a step back and think a little bit more about grassroots adoption. And this is where I want to dig a little bit deeper into the data that we've seen. So there are a couple of use cases that have become more prominent than the others when it comes to stablecoins, right? One is something I'm sure we're seeing both in terms of on-chain data, but also anecdotally, is the increasing use of stablecoins in countries with challenging or unstable economic conditions, right? You have high inflation rates, your currency is devalued a lot. So what do? You turn to stable coins, which offer you a better store of value, right? Some of the top, I think, 4 or 5 countries in Chainalysis top 20 crypto adoption index, they were all these countries that had really unstable economic conditions throughout the year. And we saw some correlations in terms of how that progressed. The other thing we've seen that's been pretty interesting is the use of stable coins for things like cross-border payments, right? Especially by merchants in jurisdictions where your dollar access is either not available or available in a limited capacity, or it's not accessible because your banking infrastructure may not be sufficient to fulfill that demand. And when these merchants or these businesses are importing goods, they use stable coins almost as a proxy for dollar, right? And I think we did some research, and from Q3 of 2023 till the next 3 consecutive quarters, we saw a significant jump in how these merchants were leveraging stable coins for cross-border payments. And the final one I just wanted to throw some light on is the whole idea of remittances, right? Just looking at on-chain activity, it does become a little bit difficult to discern whether this is remittance or is this some other kind of activity. But we tend to look at the size of transfer to ascertain whether a certain on-chain activity is remittance or not. So it's obviously an approximation, but what's been interesting is we've seen the retail size transfers grow over the past several quarters, while we've almost seen a significant drop in very large size transactions when it comes to stable coins. So once again, it's suggesting to us, given how the economic conditions are, and we obviously do a lot of anecdotal research, that the use of stable coins for remittances has also been growing over the past few years.
When I listen to that, Arushi, it reminds me a lot of a narrative that was there for Bitcoin a few years ago, which is remittances. Currencies are weak, so here's your alternative, and going from there. So, are we now seeing and this is open to all, right, to kind of put their views, that Bitcoin in particular, I think Ethereum never held that role or position globally as per se, but is Bitcoin now being largely restricted to an asset store of value, in the sense of, we see this appreciate, this is what we're going to invest in. So an investment asset versus something that can be actively used for payments. I've always held a view that Bitcoin failed from its initial proposition for being a payment between two individuals and removing intermediaries, and now that's changed. But yeah, what are your thoughts?
Yeah, absolutely. I think you summarize it well. What was the subtitle of the Bitcoin white paper? Can't remember. P2P cash, right?
Yeah.
And it's not really used as the whole idea of hodling is about using it as digital gold. So the kind of narrative or the analogy changed from being P2P cash to being digital gold. And stablecoins are just a lower friction way of storing money and hedging against your local currency volatility and inflation. So if you're in Argentina, you'd have stashed dollar banknotes. And even today in Argentina, I think per capita, Argentina has more dollar banknotes, bills, than the Americans do, which is a mind-boggling statistic. So if you're in an economy like a Lebanon, like an Argentina, where there are obviously pockets of wealth and historically lots of wealth, but you've had multiple decades of economic uncertainty and mismanagement, you end up with this real, bottom-up demand for anything that's a hedge. In countries like India, historically, it's been gold. But there's a friction cost to this, right? Holding dollar banknotes or physical bars of gold, whether in your house or in your safe deposit box, there's a physical cost to it. And even if you hold it as jewelry, and stable coins are just less friction. So just like everything digital is less friction, and that's why it works. Stable coins are like that. So I would see stable coins as what we have as P2P cash, and I would see Bitcoin as digital gold or some kind of investment asset. That said, I don't think the main use case anytime soon of stablecoins is the payment person-to-person element. The main use of stablecoins, and I don't have the data, others, be it Chainalysis or other firms like Chainalysis, track this better than me. But I'm sure if we did a chart of crypto market activity and stablecoin activity, they would kind of parallel. So crypto market activity in Q1 was very strong. Q4 2024 was very strong. Q1 25 is obviously prices have come down. There's been a classic travel and arrive or whatever it is. And you've not surprisingly seen the stablecoin volumes related to crypto trading activity slow because the crypto trading world has slowed. I think there's a little bit of boosterism. So I totally get why stablecoins are like the chat GPT of blockchain, if you like.
That's going to be the tagline there, yeah? Chat GPT of blockchain.
Everything is a chat GPT or something, right? So it's like it's the killer app in many ways, stablecoins. But we're a long ways away from it, from being primarily a payment asset. But that's in the crypto world, it's the nearest it gets to a payment asset is stablecoins.
And Sean, go on, yeah.
No, I was going to say 2 points, right? The Bitcoin white paper, remember, I think all of us that read it back then also thought that it was an experiment, and it was the first of many, right? It was the absolute first. So to actually look at Bitcoin in its theory as a peer-to-peer kind of cash equivalent or cash transfer equivalent, and then compared to where it is now, kind of 15 years later, is probably a little bit unfair, I would say, right? It just happened. Like if you think about it, 15 years later, the network's still running. It's never been down. And actually now people are hoarding the underlying asset. That by itself, even though it wasn't the original premise, is already phenomenal to look at, including a president of the United States, openly talking about Bitcoin as a reserve for the US. But fast forward to now, though, if you think about the notion of stablecoin kind of being used for peer-to-peer remittance, as Arushi mentioned, purely from the data that she's seeing as well, that absolutely works. The problem, however, moving forward is that, okay, so you send a US dollar, say USDT or USDC to someone in Argentina, right? Because their local currency is highly volatile and continue to depreciate against the US dollar. Then the question becomes, what do they actually use it for, right? The local off-ramp has not actually been figured out. Yes, you can now make US dollar equivalents more readily available in developing markets, but it doesn't solve the last mile problem. The last mile is actually very critical. And yes, some people say, oh, don't worry, I can now put a Visa, MasterCard on top of it. You can deposit your stable coin, and now I have got a card. You got to remember, one, there's card fees, and two, most of these developing markets don't actually use credit card all that much. And there's a reason for that, right? So again, the underlying problem still has not really been solved. So I think a lot of companies, including ourselves, like are really looking at the fact that, okay, stablecoins here to stay. It's growing. We know that. Right now, it's close to 100% US dollar based. Are there room for other currencies to actually play? Because if you compare how stablecoin today is in terms of dollar denomination, and you compare that to actual traditional fiat money, which is roughly about 60% for use for international settlements, that's a 40% delta, right? And you would like to think the two numbers are going to normalize at some point. Now, how long it will take, what form it will take, that's really the question. But if you think of stablecoin as a new financial infrastructure that underpins the new kind of blockchain-based transfer system or unit of account, then actually having other currency-backed stablecoins that are regulated under the local regime becomes very interesting. And that's quite frankly, some of the technology and premise that we are building towards as a company. But I think this is really worth paying some attention to as this space continue to evolve.
So you've seen kind of this evolution, right? So let's just stick to blockchain-backed stablecoins. Initially, very hard to get banking links to crypto exchanges, centralized exchanges. That's not, DEXs are a more modern phenomena per se. So you had to find a way. So you found a way where somebody would accept dollars converted, and then you go now to the exchange and you do that. And the access was easier that way. Then we started seeing newer use cases come in. You had this evolution, like remittance and other elements. And now we're building towards other things that it could potentially solve, or are we, right? I always think that once you have, there is a gap broadly in digital finance, right? Where albeit there has been significant strides, especially in the global south, to use that term very loosely, where we've gone from leapfrog from cash directly to digital money. There's still a huge number of people who are unbanked, right? And also probably don't have that digital access, though it's fast increasing. So their experience of money is digital money for many people, right? The first thing is they're using some peer-to-peer from M-Pesa all the way to Paytm, Alipay, or whatever they may be, right? So why would, in a local jurisdictional play? Would we still need stable coins as people get more digitalized and have digital access to digital money? Do the stable coins matter at all? Cross border, I get it, but from a local perspective, do we see major use cases in a domestic environment, or are stable coins going to be largely now a story of cross border? The exchange access may still, that may on off ramps may still continue for a little while we await global regulations or regulations in most countries, maybe 3 to 5 years. But after that, is it going to be limited? We're talking about cross border. Is that what is going to be solved?
I mean, I think cross-border is definitely a major use case. There's no question about it. Whatever currency denominated stablecoin, I mean, that's going to be a big thing. Local, domestic, I agree with you. Like if you have a stablecoin that's specifically designed for one jurisdiction only, especially given those of us that are in Asia where kind of mobile payments is so prevalent already. The use cases are not as pronounced. With that said, it's not, if you look broader, from only just stablecoin itself, and you include things like programmability in terms of kind of incentives, then all of a sudden that changes the perspective, right? Like just think about this. Those of us that live in Hong Kong, like every time we go to a restaurant, we go to a 7-Eleven or whatever, before we even pay, they will ask you, are you part of this program, that program, this program, A, B, C, D, and E. And I'm going to be like, oh, I'm part of A, I'm part of C. And then I have to come up with a QR code, tap it first before I actually pay. If you add that programmability into the coin itself, and as soon as I tap, because of the fact that it recognizes who I am, and obviously the wallet has to be KYC, but then it also have that aspect built in, then essentially, if you think about it, it's no different than getting airdrops, right? It's automatic. If you own the assets, you're entitled to get an airdrop, and there you go. So if you add that notion of the incentive in the form of loyalty points or whatever it is, and then automatically bring it in, then that completely changes the user experience. I think from a local kind of domestic usage perspective, that is certainly an area that I've seen a lot of players trying to explore, trying to work with the local payment providers, and to be able to elevate that user experience. Again, it doesn't replace the mobile payment system. I think that payment system is still there, but it's just a new form of currency on that mobile payment system that have additional programmability to it that enhances that user experience. That's what I'm seeing.
I think when it comes to domestic payments, the challenge with stablecoins is that domestic payments, if it's involving money, is something that's sanctioned and authorized, approved by the central bank or central bank equivalent in the country. And then you need a domestic currency stablecoin because most stablecoins are dollar-based. So would most central banks or financial authorities be happy with a parallel system? It has to be local currency. So I would think that potentially the most interesting angle to watch for the next few years is the US is introducing stablecoin legislation, right? Pretty soon. And this is potentially a game changer. I say potentially. I don't know if it is, but it's potentially a game changer for stablecoin usage in payments because the US, or at least the current US administration and likely even future US administrations, will not bring in a CBDC. And I don't know if you want to go down that CBDC rabbit hole now, but most other jurisdictions will bring in a CBDC. They're trialing CBDCs, or there'll be some kind of
I don't know. My views change on that, though.
Has it? Okay, we'll love to hear your view.
Touch on
But the US is this very 19th century idea when it comes to money or banknotes. In the 19th century,
Checks.
actually Hong Kong still has it, but in the 19th century, banks issued banknotes, not central banks, because there wasn't a central bank in the US. There was individual commercial banks issued banknotes, and you still have that in Hong Kong, Scotland, Northern Ireland, but those are vanishingly small number of countries. And in a way, that's the mental model for me for stablecoins, whereas in most other countries, one issuing authority issues it directly. Might be printed elsewhere, but it's so I think conceptually a lot of countries feel comfortable with CBDCs and the US doesn't. So if the US pushes ahead, it'll be interesting to see if, like you pay with in the US, Visa and MasterCard now, largely at point of sale. And sometimes banknotes, will there be a third rail, the stablecoin? In other countries, I think the governments are keen to push CBDCs. Musheer, you just said you've changed your mind. So you tell us what you think of CBDCs now.
I'm going to get Arushi's view as well. So there are two things. When Sean was also mentioning about programmability, so we can think of 2 points here, right? But CBDCs, one of the big push for CBDCs is programmability. But having said that, I don't think central banks and governments will actually go too deep into programmability beyond subsidies, monetary policy controls largely, right? Those kind of elements. They're probably not going to go into partnering for loyalty programs, etc. They don't want to do the programmability, whereas that's where stablecoins could kick in. I would wonder, and this is adding layers, and this is going to be fun, is whether we're going to build stablecoins on top of CBDCs, right? Which is a possibility.
Exactly.
It's an adjacent business model and a possibility. So that's on one side. On the other side, why I'm thinking that CBDCs, I've changed my mind a little bit, is the way the US is looking at it, right? I mean, if you read about, okay, we're going to allow for regulations, we are asking for banks to now, bank crypto companies, we're going to make prudential treatment better, etc. And, but there's a very clear line in almost all executive orders, not going to promote CBDCs, right? You could argue that the US, as you said, 19th century may be a little unfair, maybe 20th century system where they've just digitized checks, right? That is one of the things that I mentioned that is not going to have this thing and push for digital financial services. But just given if the world's largest economy does not have a CBDC, so when multi-currency CBDC systems are connecting, where does that go? And if your number one or number two trade partner is going to be the US, do you want to do it? And because of political connotations, and I don't get into too much of it, hence a lot of them haven't developed regulations yet. So I think that CBDC being built, everyone's experimenting. It's probably a dozen or so who actually have any shape or form of a CBDC released in POC or live, right? Whereas the rest of them, I think, are now, instead of being 5 years away, are probably being pushed to another 5-10 years away. So, 2035, 2040 story. That's where I stand. Arushi, thoughts? We're debating CBDCs versus stablecoins and whether CBDCs are still the flavor of the year for central banks.
I think before getting into CBDCs, I know I fell off the grid for a couple of seconds there, but I just wanted to touch upon that whole idea of whether crypto payments are going anywhere, especially in jurisdictions with sufficiently well-rounded systems in place, right? So again, going back to data, we did some research for Singapore, and we found, and I think this was Q2 of 2024, that we saw that the value of crypto that was received by merchant services had already reached about $1 billion. And this was much higher than the last 2 quarters that we were tracking. And this is a jurisdiction with fantastic digital payment rails, right? And there's no dearth of digital payment options, I'm going to assume. But even then, we saw that people were using crypto for payments to merchant services. So that kind of makes me think that maybe there is scope for stable coins to be used for payments, even in countries where you have good payment systems in place. But of course, I think that I will put off to the data as and when we keep kind of updating it. But there's another viewpoint, because when you look at crypto usage or stablecoin usage in a particular jurisdiction, one side is the retail payment story, but then you have this whole other side of where you've got the traditional financial institutions who could be leveraging stable coins for a variety of reasons, right? And I don't know if you want to discuss this now or later, but we are obviously seeing, right, banks becoming issuers or in the process of being issuers. We are seeing banks or other financial institutions also looking at stable coins as collateral for various purposes, right? This could be treasury management, but this could also be how they, at the end of the day, use these as collateral for digital asset transactions. So I think what I'm trying to say is we will definitely see a host of non-USD backed stable coins come up in this year. And the use cases are going to be very, very varied, not just retail payments, but across the financial domain is where I see it moving.
Sean, you're building a stablecoin with the purpose. So the
I mean,
two-layer
yeah.
question here, right? One, a lot of people like using HKD as it's already a pegged coin, so it's a stable coin. So we have a digital HKD. So hey, we're done. EHKD is done. While you're building as and actually dovetails well with what Arushi is talking about, right? Who are going to be the issuer of these stable coins, right? Are we going to have, and I'm not going to say central banks, I'm going to say government-linked institutions, state-owned institutions, be it a bank, like, you permit, as Hong Kong does. It's a very nice way of saying a similarity where Hong Kong allows HSBC, Bank of China, and Standard Chartered
Bank
allows mandates to print the banknotes. Will this be a way of looking at it where they'll say, okay, licensed financial institutions can do it, versus private bodies like yourselves and others, Circle, etc., who are not banks and don't have other financial services, but purely focused on the stablecoin business model? So why do we need this layer on top, right? Essentially, I'm like questioning your existence and all the effort you've put in the last 2 years, but
no,
you should have been trained on the answer by now, right?
No. Look, this is a question I still ask every day, right? Because fundamentally, the market is evolving very quickly. And more importantly, regulation is evolving very, very quickly. Ronit was talking about kind of the US really pushing everybody along. But, at the end of the day, if you look across the world, there are probably 6 or 7 jurisdictions, and now adding the US to the list, that are enacting stablecoin specific regime, right? And there's a reason for that. So you look across in Europe, obviously you have MiCA, more around the kind of the e-money treatment in the form of stablecoin. And then of course you have Japan, Singapore, UAE, and then also obviously here in Hong Kong and a few other places. So fundamentally, what you're looking at is are really 2 things. One is as much as the world continues to use US dollar as the predominant settlement currency, no jurisdiction, especially strong economies, would want to have US dollar across the board, right? And if we continue to push forward the narrative of stablecoin continuing to grow and continuing to kind of facilitate more blockchain-based finance, then these jurisdictions are looking at protecting their own sovereign currency. So that's the first thing. There's a reason for that, right? And then the second thing is, if you then think about the notion of using a blockchain fundamentally, right, to transfer value, then if you're transferring value on the blockchain, then there is no de facto requirements of using US dollar, right? If Brazil is selling soybean to China at roughly 80 billion a year, and then China obviously selling electronics and EVs back to Brazil, then these 2 countries can essentially use Brazilian real and Chinese dollar to directly trade. Now, you can argue that could be in the form of CBDC, and certainly that could be the case from a central bank settlement perspective. But if it's businesses to business trading with each other, then using a form of digital currency, potentially like stablecoin, makes a lot of sense. Now, then the second part of your question is, what type of issuers should we be looking at? Are these banks? Are these private issuers? And that really depends on the jurisdiction that I mentioned before. These regimes, some of them mandate that it has to be financial institutions to be the one being the issuer of stablecoins. Some others, for example, here in Hong Kong and in Singapore as well, do allow for private issuers that are working with financial institutions to manage the reserve, but themselves can be actually a private issuers that are not a financial institution. So it really depends on the jurisdictions and the regime that are being put in place. But fundamentally, I think for institutions to start using stable coins, especially any type of currency stable coins, then I think there needs to be some sort of standards in place in any type of kind of facilitation or network where the equivalent is in place, right? So you can't exactly have a local currency that is algorithmically driven, and then another one that's crypto asset backed, and then another one that's fiat backed, right? That's just not equivalent in terms of standards. So I think what you will see is more issuers that are working on fiat-backed currencies and people putting together network facilitation tools, whether that's in the form of DeFi or some other platforms, to be able to bring these currencies in place. And then realistically, what will actually evolve from there is much more than just purely a cross-border payment system. It will evolve into an on-chain FX market, right? And I think that's really where the potential happens, because the FX market is fundamentally the largest market in the world. I mean, bar none. When you start to have currencies that are actually on-chain, living in the digital format, then actually creating an FX market that's entirely in the blockchain becomes very, very feasible. So I think that's where a lot of the thesis and the directions that we're seeing from a business and from an industry perspective, and we'll see where that goes. And maybe one last thing we share. I think Arushi was talking about, there's some banks that are also evaluating issuing stablecoin. It's actually interesting to think about why a fractional reserve bank would want to issue a fully reserve-backed stablecoin, right? It probably makes much more sense to issue tokenized deposit that sits on the bank's balance sheet that can also be living on the blockchain and still having a lot of the same kind of functionalities and speed and feed and transparencies and whatnot. But a fully backed stablecoin is interesting to think about in terms of commercial viability.
And that was one of the things, right? You have tokenization of money market funds, and all of this is all validated, they're all audited. And I want to bring this question to all of you. There have been two things broadly that I want to talk about from a risk perspective. One is the question on audit of the reserves, right? Whatever they're being invested to, and the ability to redeem your stable coin. You have, out of that $230 billion, about 70-80% is being offered, if not higher, by two companies, right? Both US based. So you then have this question about audits on their reserves, their ability to redeem if there was a mass request that comes in when people want to shift, maybe, hypothetically. And second is the technological risk from what we haven't spoken so much about, non-fiat backed stablecoins, which could be algorithmic stablecoins like the Luna Terra collapse, which is a massive $30 billion plus loss of investors' value, right? A lot of people lost money in Luna Terra. Many companies were wiped out, and there's broader implication across prudential implications. And they are algorithm backed, right? So you have the technology aspect where if you're going to link it to other assets, they're not as liquid and redeemable in the market. So if I have treasuries, I have bonds, most of the US markets are fairly liquid. So you could go to trillions of dollars and probably be able to get out of it fairly okay. Whereas most of the others are not as liquid. And when big orders come in as a former commodities trader, you can see that things just disappear. So how are these risks going to be managed going forward? Are we ready for it? Is that stabilization kicked in post? So governance, is the governance strong? Are we seeing elements of that being okay for now? Are we now in a place where everybody will be able to audit and ensure both technology and reserves? And second, the prudential risk of it, which scares a lot of the central banks and stability boards, financial stability boards, because it can have a cascading effect.
I think of it, Musheer, as a work in progress.
Okay.
Stablecoins only just beginning to go mainstream outside the crypto ecosystems. They're obviously very large, very well established in the crypto ecosystem. But in terms of going into what's often called TradFi, this is just the start. So just as the journey other technologies have gone through, think of cloud. I think cloud computing is quite a good analogy here. When it started, well, approximately 2 decades ago, initially the financial regulators were highly, how should I put this politely, cautious about cloud. And it took a while. And it would probably make sense if you were a financial regulator or a stability board or a central bank, and you looked at a secondhand bookseller saying, I'm going to put everyone's compute onto my systems, you'd be like, oh. Roll forward 20 years, you're looking at a much more well-managed, well-governed, technologically resilient, robust company, one of the biggest in the world, right? Amazon, and there are others. So that evolution that Amazon went through, Google went through, you're probably going to see as well with the existing stablecoin issuers, the Tethers and of the world, and then others that we're going to see grow, because just like, we've had different cloud providers emerge over time, and if you're in China, you have your own, you're going to see different stablecoin issuers. Same happened in social media, etc. There'll be particularly in the non-China world, there'll be some dominant, maybe American players, but it's going to be interesting to see how the world evolves in the next. None of us know, because we've got a very, again, you could say in good and bad ways, disruptive political environment. How we're going to look 10 years down the road in finance, who knows, right? Because money follows power and politics, and this is all evolving very, very fast. Maybe we'll get I mean, for sure, inside the China block, whether it's a CBDC or stablecoins at the back of it, highly state regulated, you're going to get. India will try its own. And it'll be interesting to see what Europe does. Europe seems to be waking up now.
The interesting thing about Europe, the interesting thing about Europe is under the MiCA regime, any stablecoin that's not regulated under the regime is already have been asked to be delisted. So Musheer, you talked about kind of tether, right? Like there's no tether anymore in Europe. So I think you're going to continue to see more established jurisdictions that have their own regime, like I mentioned before, protecting their own sovereign currency, but also to ensure that just because you have a stable coin doesn't mean that it is actually legal to use in a new jurisdiction. And I think that's going to be quite critical. My degen friend will say, "Oh my God, that's more fragmentation. We finally brought a lot together. It's all decentralized, blah blah blah." But of course, you can't ignore the fact that there are a lot of very gray-ish activities that are being used in this space. So it will continue to evolve. But I love that analogy Rohit mentioned, right? The cloud analogy. That's my world before I came into blockchain and crypto. I still remember, taking regulators, I won't name who, into a data center and tell them, look, this is the cloud infrastructure. And they looked at me and said, wait, I thought cloud is in the satellites. That's why you call it cloud, right? And I'm like, no, that's the communication relay. The physical infrastructure is actually down here, which has created this layer that seemingly is, not locked into a physical location. So there's a lot of education that needs to go on there, but that evolution and understanding in terms of stable coins that are running on decentralized, permissionless infrastructure will take some time to sink in. And just look at the Basel rules, right? I think both Singapore and Hong Kong recently announced that they are going to follow the Basel rules. So any banks that are holding crypto assets, even including stable coins that are running on permissionless networks, will have a certain category, risk rating, and it's actually at the highest, right? 1,250% risk rating or whatever it is. So again, it goes back to Arushi's point earlier. Does it make sense for a bank to actually issue stable coin when it's fully reserved, and two, they need to have, I mean, the capital requirement is tremendous. Does it actually make sense? I mean, I wonder.
Yeah, and unless they go on permissioned chains, which is a whole different conversation.
Then what's the point? Then again, what's the point, right? It's like kind of going 2 steps forward and 1 step back.
Yeah, that's true. And I mean, also on the risk piece, right? Like both Sean and Ronit touched upon it, and Musheer also kind of mentioned there's a couple of risks that global standard setting bodies and national regulators are looking at. And at a very broad level, I think they are in agreement. There is a consensus, right? We want to make sure if you're putting 1 million tokens out there, you have $1 million to back it up, either in cash reserves or in high quality liquid assets. In some way or the other, you have to show us you have enough to back it up, right? And the second big thing is, if someone has taken your token and they want to redeem it, you're able to redeem it within whatever time frame your national regulator puts in place, right? That's the second one. The third big one that at least we see very often, and this is especially where we are seeing some industry practice evolve, is the risk of financial integrity. The whole AML, CFT risks that's emerging in terms of how sometimes this category of crypto assets are being also used to facilitate financial crime. And there are a few things being done. There are ways, for example, there are stablecoin issuers that are putting out monthly attestations, even sometimes in the public domain, in terms of what the reserve asset looks like, and that's evolving. There are some who do not, which are circumspect. In terms of redemptions, again, in terms of financial integrity, we are looking at issuers, especially the bigger ones, leveraging on-chain data to monitor their risks, because the rules are somewhat clearer on what primary market monitoring looks like, but there's not a lot of clarity in terms of what the secondary market monitoring looks like. But on-chain data kind of simplifies it, and that's where a lot of these stablecoin issuers are already incorporating this, even though this may not be super set in stone at this point. So yeah, it's evolving, but then every regulator does have its own approach. Like Singapore's approach is somewhat different from UAE to Europe, but I think on a broad level, everyone's in consensus. These are the key risks that we need to watch out for.
Agreed. I think we're also seeing regulations being driven by an overarching drive or recommendations from both ISCO as well as the Financial Stability Board, right, which was through recommendations to the G20, driven by Indian Finance Ministry, also asking for that 2 years ago. You had a similar story last year where the Biden administration asked various departments to come up with their recommendations, and now you're seeing the current US administration also doing this, right? So I do feel the regulations are now in place in the major jurisdictions, or about to be in the next 6 months. If you consider GENIUS Act in the US as well as what's being expected in Hong Kong, then you probably have the major financial centers internationally having some regulatory reference on stablecoins. That EU already has, as Sean mentioned. We could, and probably in the next 2-3 years, we will see some harmonization of those. This is a topic that we could keep talking for a very long time. I think it needs a forum versus a podcast alone. Instead of the walk-in, walk-out, it's like, let's stay for a few hours discussing this, and maybe we'll do one later on. But as we wrap up, what would, if you had to say, right, and I want to keep it for 2025, because I feel looking beyond 2025 is actually a lot of too much stargazing and prediction. But what is one thing each of you feel, and I'll go around the table, that excites you the most about stablecoins, and one thing that worries you the most, right? So we're going to do both sides. Ronit, how about you? Start with you.
Sure. I think the US bringing in a set of rules around stablecoins is definitely a game changer, as I said before, and so that's a positive for the ecosystem for stablecoins and more broadly for crypto and blockchain. It's a very big positive. What worries me is, and I don't know how this plays out because it'll change over time, but worries me is how dollar denominated it is. Now, this is great for, I own a lot of dollar assets, and I'm living in a country that's dollar pegged. So personally, it's not an issue for me, but there's a couple of hundred countries in the world. Stablecoins, like all new technologies, could be a force of homogeneity. I get told constantly by my crypto native friends that, oh, it's being, used here and there and everywhere, and this is positive. I get that. But there's also a huge kind of homogeneity from a financial perspective, from a currency perspective. The world needs lots of currencies, just like we need lots of languages. We need biodiversity. This could be, at least in the short term, a homogeneification force, if that's a word.
Homogenification, if that's a word. You're the Oxford educated person. Was it Cambridge? You should be the one telling me this. Arushi, one thing that excites you, one thing that worries you?
I mean, like Ronit mentioned, definitely the US evolution is exciting to watch. Where it'll land is something that would be interesting for the rest of the year. I'm also excited about the whole potential of stablecoin to go places. Like I mentioned, especially the data that we keep looking at, it tells us how a lot of this activity is evolving, and it's very, very interesting. What worries me personally is the facilitation of crime using crypto, even though it's like less than 1% of all crypto activity. The fact remains that it does end up impacting a lot of the retail small users. And I think that's definitely something that worries me and concerns me. Yeah.
Thanks. Sean?
So both Rohit and Arushi already mentioned the US, so I'll skip it. I think it's a positive, but I think if we look behind the scene, there's a reason why the first policy that will be pushed forward from a crypto agenda perspective is stablecoin. Not Bitcoin Reserve or anything else. It's stablecoin. There's a reason for that. It's make America great again, right? So there's that whole notion there. But overall, for the industry, it is good. What worries me about is the notion of yield-bearing stablecoin. So what form does that live in? Is it a security? Is it not a security? Should it be treated equivalently, even though it's also called a stablecoin? I have a lot of concern about different jurisdictions coming up with different rules around yield-bearing stablecoin that makes it even more fragmented. So that's what I'm keeping an eye out on this year.
Thanks. I think what's exciting me is I'm seeing more stable coins that are coming up, which are going beyond the fiat, not the algorithm, but commodity backed. Gold seems to be a favorite for many people. And I want to see how that plays out because gold for large parts is now a store of value versus, being even jewelry usage, industrial usages aren't as massive. So that would be exciting for the coming year, both across the three regions. I think gold is a big marker, Middle East, South Asia, and in the Greater China region. In terms of concerns or risk, my worry is once these regulations kick in, and if one of the major, Tether in particular, but have to pull out of these regions, we will see that going back to, I'm trying to call it not debanking, but the challenges with on-off ramps for legitimate crypto activities, right, from trading to transfers, etc., may become a massive challenge because the banks may not be up to it. They're still very conservative with fintech and standard remittance players that have been there around for a long time. So with crypto, that could become a challenge, and then we may see gaps happening. Besides, also a concern about one stablecoin blowing up somewhere, which may or may not happen with ZKP, but that will be the other concern. So that's, I think, a good point to end on. A lot of excitement, but a lot of concerns that we also need to be aware about, but broadly positive conversation. Thank you all for a very deep and insightful conversation. As I said, we could keep talking about it for a long time. So once again, thanks for joining us.
Thank you. Thanks, Musheer.
Thank you.
Thank you for
Thanks.
inviting us.
Audience, stay tuned. We're going to have more of these insights on the BWA podcast powered by FinStep Asia, talking about a variety of different elements of Web3, be it crypto, be it digital assets, be it tokenization, and follow the BWA YouTube page and LinkedIn page to keep track of these updates. So thank you very much and stay tuned.